Hey, good evening, everyone. This is Brad Shaker, CEO and co-founder of Skylight Health. Pardon me for a second. It's the first time I've used this platform, so I want to just make sure that everybody can hear me. So I'm just checking, and it sounds like we're good to go. So first of all, happy Tuesday evening. Thank you for making time for joining us today. I'm first of all very appreciative that each of you have kind of taken some time out of your day to send over some questions that you like addressed. I'm going to do my best to be able to address as many of these questions as possible. There has been a lot of questions submitted, so I'm gonna lead to the questions that have been submitted so far. Because the chat box works and I can't see the chat box as I talk, if you have any questions, please don't put it in the chat box. Email it to investors@skylighthealthgroup.com. And Jackie on the IR side will do our best to kind of get those questions over. But again, we're going to try and do our best to keep to as many of these questions. I think they address a lot of what the feedback we're hearing, and obviously many of you are asking on your side as well. So first of all, I want to, before I get into the actual questions itself, I know overall there's a lot of concern, especially looking at the stock chart, looking at the performance. And look, I'm going to do my best to address what I understand is happening out there. But I'm going to say this a few times on today's call, so hopefully you don't get tired of me saying it. The company is not the stock, and the shareholder value that we're looking to build is truly something transformative and not reflected today. And so as I begin these questions, I just want everyone to know that what you're seeing out there is certainly not a reflection of what is happening within the company. And some very exciting things happening and a lot of potential opportunities we're looking to present here in the near term. And I'll address that as we go through these questions. So again, thanks everyone for joining. And let's start kind of hacking away at some of these questions. So one of the questions that was addressed was our patient count. People want to know sort of what the numbers actually are. About a year ago, we probably started commenting about patient counts over 200,000. Today, we're talking about a qualifiable patient count of about 80,000 patients. So let's kind of take a little bit of a debrief into what these numbers are. So for those of you who know Skylight Health prior to 2020, you'll know that we were formerly CB2 Insights, and our business model in CB2 Insights was quite a bit different. Over the course of the last 6 years, we've been focused on a space where our acquisitions have been primarily focused on a alternative focus of healthcare, not primary care. Through this, there were a number of patients acquired as part of these clinical acquisitions, and these patients are not necessarily all primary care focused patients. So I know that there was a little bit of confusion when we talked about patient counts. Why all of a sudden did patient counts decrease? It's not because we had an attrition rate. It's more so because when we look at the primary care business of Skylight and the qualifiable metrics of those patients today, we see them as insurable services patients. And so we're talking about patients who are carrying insurance programs with healthcare payers in the US. These are patients who are coming to us for insurable services. And there is still a significant amount of patients that are not under the insurable services banner of Skylight. We refer to this more so as part of a legacy business that exists within Skylight. And we're looking at various options today about how we can deploy those legacy business assets, being patients, clinics, locations, providers, into what we're driving forward at Skylight. Certainly, our focus is not changing. We are focused on the value-based care market. We are focused on the primary care market. And as part of that, whatever we can look to benefit, we will. But we're also exploring options whereby we'll be able to keep that focus and keep that growth going strong. So when you look at the patient count today, when we refer to qualified patients, we refer to primary care patients, we're referring to patients that are within a insurable services model. And so I'll move on to the next question. Some of these questions are a little bit, maybe, I'm not going to say challenging to answer, but I'm going to do my best to address everything head on here. So quite simply put, one of the questions was, why was the stock pumped so hard on Wall Street Reporter? So I agree that in some circumstances, Skylight was looking at creating a broader investor base. Again, for those of you who remember Skylight a year ago, actually maybe a little bit over a year ago, you'll know that we were in a very different position from both a company perspective and a valuation perspective. We really did a lot over the last 12 months to build an investor audience. both on the institutional side as well as the retail side. We're mindful of the messages and the growth that we communicate to both an institutional and retail audience. You'll notice that we've since pulled back many of those types of marketing channels whereby we went out and we're communicating what we're doing and what we're focused on. There are effectively two challenges that happen when you're in a growing company. One, you're pivoting as you grow, which means you're learning as you're building. And two, you often have to communicate what that future opportunity looks like. And so when we had considered various communication strategies over the course of different promotional tools that we were using to build Skylight brand, effectively we were looking at messages that may or may not necessarily have been understood within a time frame and context that we're trying to communicate. Now, keep in mind, we're not operating in a space that's necessarily easily understood. Healthcare itself is quite convoluted. When you look at the US healthcare system and the value-based care space, is even more complexity. And so you do your best to simplify the message. Oftentimes that simplicity can usually confuse timing. It can often also confuse what that message is trying to convey. And there'll be a few questions here that are tied to that. The one thing I'll say is that we're not pulling back on our forecasts of where we think this business is going to go or what we are trying to build here at Skylight. But obviously recognizing that when you're building a business, many of our peers that have taken years to build it, we've only been doing this for 12 months. And I'm quite proud of our team's achievements over those 12 months. And I'm quite confident that we're going to be able to achieve those goals. And so whether timelines were misconstrued or whether timelines were communicated within a period of simplicity, I do want to give comfort to the fact that we are not wavering from our initial goals of building what we would consider a multi-billion-dollar business on the back of a very strong revenue stream, especially when we see where our peers are today and what has been proven in terms of the contracts that Skylight is looking at winning in the next 3 to 5 years. Another question that comes across frequently are the institutions. And so part of our conversation, especially prior to the Nasdaq, we had talked a lot about where we are as an organization from a marketing perspective and awareness perspective in the US market. When we were initially marketing Skylight on the road in the US, we had a lot of great feedback from institutions that showed a ton of promise and interest. Now, the US is largely research-led as opposed to banking-led. And so the research analysts need to get behind your story. And research analysts from firms like Cantor and Canaccord and Oppenheimer and Lake Street and Northland continue to show great interest in the Skylight story. But one of the things that we have to recognize is there's two parts to Skylight's investment thesis in the US. One, we're a low entry point for anyone that's looking to invest in the value-based care space. Why? Because our peers all traded multi-billion-dollar market caps. But our peers that traded multi-billion-dollar market caps have also de-risked the execution because they already have contracts because they've been doing it for 5+ years. So when you're talking to an institutional client, you're balancing the act between de-risking and at the same time valuation entry. So it's no surprise to me that investors are going to want to see periods of execution. I don't think the lack of institutions to date is necessarily a signal that there's no interest in Skylight. In fact, we continue to market. We continue to be on non-deal roadshows and spread the name. We've already seen research come out of one US bank, and we're working on continually building that research coverage up with other research institutions in the US. Again, institutions listen to research, and research is our primary focus. That said, I think there was an expectation and maybe an expectation that we would have come onto the Nasdaq with a institutional partner. To say that we weren't planning on it, that's not true. We were, but we were also mindful of what that institutional participation would have cost us at that time. Look, in hindsight, based on how the markets are going, we necessarily can't predict. But at that time, that cost was too expensive for Skylight. And we counseled with a number of our key shareholders and decided that we had an alternative path. We had built a great following on the Canadian market. We had great institutional support here. We didn't need to take unnecessary discounts in order to buy sponsorship. And so we decided to go our own way. Now, that being said, it is important to have US institutional sponsorship. We are getting US institutional sponsorship. We do have some today. And we are continuing to invest, but invest in the right areas to bring in the right set of investors, both from a retail and from an institutional perspective. So unfortunately, it is a bit of a patience game, but it's by no means a lack of interest. In terms of the Nasdaq, so yes, in terms of a qualifiable Nasdaq listing compared to our peers, of course, we're very early. We're a sub-billion-dollar market cap. That by itself puts us early compared to our peers, where I think the lowest one is probably about a $3 or $4 billion market cap. But that wasn't the reason why we did the Nasdaq uplisting. The reason we did the Nasdaq uplisting, and I kept communicating this early, was there were really two things that were stopping investors from paying attention to the Skylight story. Number one was the fact that we hadn't yet proven out the value-based care model that some institutions in the US wanted to see. And number two was the fact that we were not on an exchange where they could access. For many of the healthcare institutional players, accessing a Canadian market isn't something that they're going to do, and accessing the OTC markets is not what they're going to do. Does it mean that immediately on the uplist that we're going to see a pouring of these investors? Again, we can't always control that. We'll do our best to get the interest. And we have seen an increased liquidity on the US side already. So to say that those investors are not in there already, I can't necessarily prove that. But as we look at the overall Nasdaq uplisting reason, I think we made the reasons for the right choice. We're on a market today where the doors are opening up for us. We're having the opportunity to be invited to conferences. We're speaking to investors who can now look up our charts and actually look at what the participation opportunity might be. And when the timing is right, they now have a way to enter. There's no bottleneck. There's no barrier for access for entry. So I do think that the Nasdaq was an important moment for us. Like anything else, when you're a microcap company, you're shouting for attention. And so we have to do our best to be able to create that attention, get out there, meet with investors, be visible, execute our business. And from that perspective, I think we're doing all the right things. We're coming out of the summer months, and we're starting to get back on the road, and we're starting to have some pretty exceptional meetings that I find are putting us on the radar of more US investors than we've ever had before. So hopefully at some point, those investors will translate if they're not already. But again, we'll keep doing what we can do within our control. In terms of a private placement, so this is another question that's come up. What is your current cash balance? How are you guys going to finance other acquisitions? There's a truth to our model. We are a acquisition-based growth company. So, raising capital, having access to capital is going to be an important part of our growth. But does that always mean that we're going to be focusing on dilution? Does that always mean we're going to be focusing on cash-based acquisitions only? No. We've had a number of conversations, and I've communicated this in the past, with traditional debt lenders, with alternative forms of financing. I think it's important to know that Skylight will be accessing capital for growth because we do have a very strong pipeline, and that has not changed. But at the same time, we're going to be mindful as to where and how we raise that capital, do our best to minimize the cost of capital, but really make sure the capital we raise is going to drive growth. We're not raising money to pay a burn. We're not increasing extreme expenses to be able to just continue to keep burning shareholder capital. Our focus is on as much of that dollar raise needs to go for acquisition-based growth, because we have proven over the last 12 months that acquisition-based growth allows us to build scale, allows us to build patient lives, allows us to build market share, so that as we continue to execute towards full risk contract agreements in the next few years, that these results will translate both to near-term revenue growth, because every acquisition we make is driving immediate revenue. Near-term acquisition revenue growth increases our guidance, increases our market cap potential, allows shareholders to see an increase during the transition to value, so that when that transition to value happens, there's a further incremental growth that can be seen at that point. So hopefully that kind of addresses the private placement piece. We're always looking, we're always talking, but at the same time, there's no reason why pressure should be placed, because there's no open financing talks where someone would feel the benefit of having to place pressure on the market. One of the questions here, again, about line of credits. So again, stay tuned. We're having multiple conversations on that, and hopefully we'll have something to present there. A common question I get is the share price. I kind of mentioned I'll address this a few times as we go on, and maybe I'll address it at the end again. So no, the answer is no. There's no reverse stock split being contemplated. We don't have to. There's no reason to. We are on the Nasdaq. That's where we stay, and now we're going to focus on growth. Why and what is happening in terms of the share price? Again, that is not a fundamental business reason. There's no reason why the market expects that Skylight is underperforming or not necessarily performing against its expectations. We have added formidable growth in the last 12 months. We have a strong pipeline for growth that we continue to believe we will add more growth moving forward. In our opinion, consulting with various capital market advisors of ours, this is not uncommon in terms of people wanting to put pressure on a stock so that the believers start to question and really start to waver in their decision on the company. And if they do, then those people win. speaking both as a shareholder, it hurts to see the shareholder value depreciate the way it has. And speaking as someone who actually truly cares and appreciates your support for the company, it hurts to see your potential portfolio also decrease. But we'll do what we can do to defend against it, which is make sure that we bring back the growth, we bring back the revenue-focused top-line growth, we focus on the fundamentals of the business that we believe will add value to the business. And then hopefully we'll have our shareholders stand by us, unwavered by any games that are being played in the market, because I don't believe, and I'm sure you don't believe if you've stayed this long within the company, that the reality of what we're looking to deliver is reflected in the share price today. The next question came along with sort of the share transfer with our new president, and also if management is effectively selling shares. The answer to the first one is no, and the answer to the second one is no, and the answer to the first one is house cleaning. We're mindful as the company's growth has evolved over the last few years of our overall option counts. Mohammed is an exceptionally strong leader. He is going to do great things in Skylight, and we are already seeing him execute on great things within the organization. I think it's important. I think Mohammed knows it's important, and I think the market needs to see important that he is not just having a position within the organization, but he actually has a solid position for growth in the organization, so that he is aligned with shareholders, he is aligned with existing management to really drive his initiatives forward and bring as much of that value for all of us to see the benefit of as we work on this together. And so this was really a realignment for both Cash and I to ensure that our new president is effectively going to be rowing in the same direction, and to make sure that we're not going to cost shareholders anything more in order for that to happen. In terms of management selling shares, I can tell you that Cash and I have not sold any of our outstanding shares. We have no interest in looking at any opportunity in terms of putting our shares in the market, especially when we see what we believe in. Hopefully we keep communicating that message to the market. Hopefully you see that in the fact that if there were any sales, it would be in the filings. But again, I want to put comfort in everybody's ear that this is not of interest to us as co-founders. I've committed to one thing, and when I talk to investors, I tell them the same thing. We believe that this is going to be a multi-billion-dollar company. We believe that what we are looking at today and the infrastructure we have is night and day compared to where we were a year ago. And when we look at the future of where we're building towards, we truly do believe that we're going to get there. Now, along the way, can there be ups and downs and learnings? Absolutely. Like any new business, that's what you're going to expect to see. But what you want is a management team that has proven that even in the darkest days, as most shareholders might have seen us 2 years ago, we haven't gone anywhere. We continue to stay here, fight through the adversities, and see our way through success. And especially now, having come out of where we came out of and seeing the opportunity to go to, a wavering share price is not going to scare us. We're still going to make sure that we see our way to success, so that hopefully, if you guys decide to stay along for the ride, so will you. So the Mackey research report, yes, of course, we have seen the downgrade. Can I explain why? Let me articulate this appropriately. Research analysts are independent. That's what they're there for. They provide an individual analysis for the market. And so from that perspective, I applaud the independence. And I say, great, your thoughts are your thoughts, and that's wonderful. Now, personally, do I agree with it? No, I don't. And I don't think you're seeing that reflected by any of the other analysts as well. What I can say is the decision made by an analyst on their analysis of what they're going to see is theirs to make, whether positive or negative. I, as management, have an opinion that I can make against that, but not for the perspective that I think that they should change it or that they should agree or disagree with it, as you should. But do I agree with it? No, I don't. I think that they're going to see that even by the end of this year, that they're going to, effectively be proven wrong. And as management, that's our job to continue to execute. And I have full confidence in our team that we have not run out of steam and we are not slowing down growth. So one of the questions that came up, which is the value-based care framework. How many patients will go in January? When do we see this conversion come on? And I think this is part of the challenge why there's been some overall confusion in the investment thesis in Skylight. And this was one of the comments that was made in the research report, is that value-based care conversion is going to take longer to achieve. So value-based care conversion is not an overnight switch. It doesn't happen that way, and this might be part of the simplicity that was communicated in short time frames and presentations. Value-based care can take a few years to get to full risk, but it doesn't mean that there's a flat line until that happens and all of a sudden there's a spike in revenues. It is an incremental growth. And so what you're going to start to see is January 2022 is the first performance year in value-based care. Over the last 12 months, we committed to growing a patient base, we committed to being able to announce value-based care, and we announced to be able to start making revenue under value-based care. We've hit all those three checkboxes. In January calendar year performance is when we start to prove that out. Now, under those contracts, each year, if we continue to perform well, which means if we execute the business and execute the quality metrics, the value of those contracts will get better. And each year, if they get better, that will incrementally increase the organic revenue within the business today. Now, along the way, if we're acquiring practices, growing the patient count, growing the revenues, then all we're doing is creating a larger base to apply those total risk contracts to in 2 to 3 to 4 years from now. And so from our perspective, I think what we're doing is bringing short-term growth by way of acquisition and executing on the value-based care competencies to see increased incremental revenue each year so that when we see ourselves under the total risk care contracts, I think people will suddenly start to realize, and that aha moment might make sense, but hopefully people will start to understand that journey along the way. And if we're not communicating that clearly enough, then certainly some feedback from investors might be helpful. And if we do need to have some further conversations or presentations around the value-based care model and how that can benefit us, certainly myself or some of our executive team members, we'd be happy to organize something as part of an educational or informational session. So in terms of LOIs that we have in the pipeline, this kind of ties into one of the other questions which we've had, which is effectively the run rate conversation. So in terms of the valuation of the deals that we have, to say that we have 100 million, 200 million, 300 million, 400 million pipeline, continue. It's a massive opportunity. But they're not locked in 1, 2, or 3 deals. From our perspective, our thesis is our acquisitions, although they may not be large and necessarily as attractive as, say, some of our peers might be buying in the market, keep in mind what we're buying are value-based care potential lives with a immediate impact on our P&L through the acquisition revenue and profitability that they bring in. These deals that we see are repetitious. Our pipeline continues to cycle. The reason we don't disclose LOIs anymore is because by disclosing the LOI, the seller now knows that you are going to have to close that deal, which means that we cannot negotiate the best deal for the shareholders and for our company. So we want optionality. There are times where we get to the finish line with the seller and decide to say, you know what, we're dropping you and moving on. But that's okay, because behind that seller are another 4 or 5 other deals that we have been working on. So the pipeline never stops. In fact, our diligence team is always busy sourcing, but also working on diligence of acquisition. So yes, we do have deals in LOIs. No, we won't communicate those deals until they close, unfortunately. I'm sorry, but you have to trust in the fact that we are going to deliver against these LOIs, as you've seen with Doctor Center and Aspire. Now, have we taken longer to necessarily close some of those deals? Yes, we have. The reason for that is because we acquired a very large asset in March. And I tell most people this, maybe I'm doing something wrong, but when you go in and have a transformative acquisition and you buy something that essentially doubles your size overnight, if you're going to keep going and buying acquisitions after that, at some point the ground under you is going to break and fall because you have to integrate. It does take time. You've got to figure that out. And so buying a larger acquisition takes us time to integrate, which means that it'll take us longer to get to the next acquisition. It doesn't mean that we don't have acquisitions in the pipeline. It doesn't mean that we don't have the cash to close on the acquisitions or access to capital to get those acquisitions done. It's just due process. So moving forward, as we focus on deals that are typically quicker and easier for us to close, I expect that we'll start to see the frequency of these acquisitions increase. But we're not going to buy acquisitions for the sake of buying them. We're going to make sure that they're accretive. We're going to make sure that they make sense, whether it's density or new markets. We're going to make sure that they have the right patient mix to add to our value-based care model in the future. And there'll be other announcements that'll come out that obviously play into the decision criteria as to which clinics that we decide to acquire or not. So again, we hope that you trust us in saying that even though we don't announce the LOIs, we do have deals that we're working on and that these deals will come to market. Now, in terms of year end, now this is something else that people ask. Well, how many deals do you think that are effectively going to be closing on an annual basis? So let's look at 12 months ago. So in 2020, we exited the year with about 13 million in revenue, and that included actually a little bit of the primary care revenue. In 2021, we'll look to exit this year today based on the guidance given for this year. And again, I know that it's nice to increase guidance after every acquisition, but we'll do it on a quarterly basis, is today pegged at 41 million. So 13 million to 41 million is where the growth has been brought in. And this growth is manageable. This growth we believe can be replicated. This growth we believe can be accelerated. So based on this revenue growth, what I can commit, what I feel comfortable committing as part of Skylight's representative here, is that we will show quarter-on-quarter growth. We are expecting to continue to make acquisitions on a quarterly basis. Those acquisitions will reflect in revenue growth. We believe that that revenue growth will fundamentally increase the business 12 months from today to where we are today again, and moving forward. And of course, that organic growth through the contracts that we have with payers will add to that growth even further. But please make no confusion that there's going to be a lack of quarter-on-quarter growth based on these acquisitions. And even though we may not spell out how many deals we intend to close this year, what the value of those deals will be this year, because there's constant shuffling of the deck, that there will be growth brought in, and you should expect to see that growth as close to a quarter-on-quarter basis, leaving some room for some integration and opportunities to focus on other aspects, not just acquisitions alone, that bring growth in the long term. One of the questions that came in was the company's filings are not on the Edgar system. That to me is something that I need to check in on. So if that's someone that has emailed investors, leave that with us. We will come back to you on why that's the case. I'm sure there's a good reason why that's the case, but certainly we'll get the right answer back to you on that piece. And I think just based on time here, there's this one more question, and I'll want to kind of wrap up here for everybody. Hopefully this has been somewhat helpful to address some of your questions. As a CEO, what would I have done differently, or what have I learned? Well, I want to make a couple of statements that are going to sound trivial here, and will take me back a little bit in time. I'm one of the two co-founders of this company. I don't think our time here is done. So to ask the question, what have I learned as a CEO? I think the question is, what have I learned as a shareholder? What have I learned as a co-founder? And what are we learning as a company? I think is probably the better answer to give here. And the answer is this. There are times when your story is easily resonating with the market, and there are times when your story becomes a little bit more complex. There are times when your investor base turns over, and there are times when your investor base doesn't necessarily see eye to eye with the execution. But the one thing that both Cash and I have been extremely focused on is making sure that we see ourselves through a vision. And so when we look at what we've communicated to the market, certainly we can expect that sometimes communication comes ahead of execution. Sometimes that might feel like we're getting ahead of ourselves. Sometimes people may feel like we're not going to deliver on what we said. And from that perspective, the intention is never to mislead, but rather to say, when we communicate something, there has to be some variance of expectation and delivery, but we will execute on what we say. I believe we have done that along the way for the most part. And so we'll continue to execute. We'll be mindful of expectations. And obviously, as we shift from a company that was a sub $10 million market cap company to a company that's trying to build itself on a Nasdaq exchange, that there are certain principles and policies we want to adhere to and have people potentially believe us, because we are trying to attract much larger investor bases today. So we'll be mindful to continue to keep updating shareholders. I think education is critical. I probably will say that maybe we haven't been on enough to be able to update how things are going or keep some shareholders up to date as to where things are happening. But we've been busy, and we'll continue to keep balancing that approach. And as much as I can come on and provide some context around news releases, be able to get a bulk of questions that maybe we might be able to answer, I will, because for all of you who are listening, you are truly part of this company. You've invested in here. You've put your belief in the business. And we at Skylight want to make sure we deliver and make sure that we hold up to our end of the bargain. And we'll do our very best to do so. So with that, hopefully we've been able to address some of your questions. If not all, please submit them to investors@skylighthealthgroup.com. Our IR team and Jackie, I think, does a phenomenal job with responding to as many as they can. And if not, we can always look to update the market again in the coming months. But I hope that you'll all stay tuned. If it's your choice to continue to stay on with the business, please keep up to date with the news releases. We do expect to have a pretty busy end to this year, and that we'll continue to keep delivering our message and making sure that we both communicate expectations, good, bad, or otherwise, but making you all feel like that there is continued dialogue between the investors and the company, and we'll execute against the plan that we have in place. So again, hope you all have a wonderful evening, and thank you all for joining. Take care.